5. Nate here as your presenter today. Today we're going to deconstruct financial markets a little bit. In this video and in this lesson, we're talking about the institutional edge, retail traders and institutional traders. Why 95% of all traders fail, and how we can join the 5% or the institutional traders who do make it, who become successful. Okay, so we're going to deconstruct these financial markets in a way that most beginners who jump into trading really ignore. Okay, we often hear about the bulls and the bears, but the real battle isn't those who want price to go up and price to go down. It's not a struggle between those. The dynamic or the real dynamic here is between two specific groups: retail traders and the institutions. Now, I'll break those down each here in a little bit, but today we're going to explore why 95% of traders fail, and how it comes down to being stuck in a mindset, a retail mindset, and trying to survive the institutional game that's out there. Okay, we're kind of in this world where, most of us in this room are retail traders, and we have these big financial institutions in there that move the market. And we're going to kind of go through this just a little bit here in this particular presentation. I want you to still think of the market as a massive ocean. And in this ocean, there are two distinct species. You have plankton and small fish. That's one species. That's the retail trader, okay, or the retail crowd. And then you have these whales and sharks, which I want to consider the second group, the institutions. And then the crucial thing to understand is that the whales and the sharks, being the big guys, move the water. They're the current in the water. Okay, the plankton and the small fish just drift around these currents or these trends developed by the whales, okay, or the sharks, the bigger fish. If you try to swim against that current, well, guess what? You lose, okay? And to succeed, you have to identify who these players are and when they're moving, so that you can jump on their backs and ride the wave, or ride the trend, or ride the current. All right? So it's about mindset. So let's talk about who are retail traders. Let's start with us, the little guy, okay? Most of us in this room are retail traders. By definition, a retail trader is an individual buying or selling securities for their personal account. You are trading your own hard-earned money. You're looking for that freedom that we talked about in the earlier lessons, income, or perhaps just the thrill of doing it. I don't know. But we have constraints. We usually have small capital. Maybe it's $5,000, maybe it's $50,000, maybe you even have a $100,000 account. I don't know. We pay higher commissions or spreads than the big banks do. Why? Well, because the more contracts you buy, the better discounts you get. Makes sense? And usually we are reacting to news that has already happened. How many of you ever turned on CNBC News and you see the headline that Warren Buffett is buying a particular stock? Well, you know what's interesting? By the time you usually hear that, Warren Buffett has already bought that stock and now he's selling it. So guess what happens to you? Boom, the big bust happens. All right. So basically, um, in Wall Street slang, unfortunately, the group is often referred to as dumb money. Okay, us retail traders. Now that sounds a little bit, you know, it sounds a little bit mean, but that's the reality. Not because we're stupid, but because we are often uninformed and emotional. Okay? Who are the institutions? Let's talk about this for a minute. On the other side of our trades is the institutions. When we say institutions, we're talking about investment banks such as Goldman Sachs, hedge funds like mutual funds, pension funds, BlackRock is another company. It could go on. Prudential, anybody that has uh, billions of dollars to trade in single moves, okay? They are not trading their own money. They are trading OPM or other people's money. And think of it like this: they have hundreds of millions, sometimes billions, in purchasing power. All right. I know it's not fair, but at the end of the day, because of the size, they don't just predict the market, their buying and selling actually moves the price. They are what Wall Street terms as smart money. They have advantages you can only dream of. Algorithms that execute in nanoseconds and dedicated teams whose only job is to calculate risk. Let's look at the asymmetric warfare that's going on between these two groups. Okay? Well, first of all, it's not fair for this fight to happen. First, capital. Let's talk about capital. If you had a bad month, you might lose your rent money. If they have a bad month, they still collect management fees. All right? The information. All right? Here's what's interesting about the information. You're reading the news article on Yahoo Finance. The article was written by a journalist 3 hours ago. I talked about that in that CNBC example earlier. All right. After an algorithm already read the raw data and executed a trade. You're always late. So by that time, if they're buying, by the time you start hearing the news and buy, they're already selling. Okay. So you need to understand that concept. Third, let's look at their goal. Okay. This is key. The retail trader wants to get rich fast. The institution simply wants to stay rich forever. The difference in goals create a massive difference in your strategy. So be aware of this as you enter the markets. It's very crucial that you gain this knowledge to know what a retail trader and a institutional trader is. All right, so we talked a little bit about this here, this asymmetrical warfare that's going on, and it don't seem fair. You might hear people talk about market manipulation. The big banks do that, the hedge fund managers, and it's out there, and you can go find videos on YouTube about it. But the reality is they stay within the rules of the game. Okay, this brings us to the most famous statistic in trading. You've likely heard it. 90 to 95% of retail traders are going to fail. What does that mean? Let's think about it. If we're the retail traders, there's a good chance, the odds are against us, 90 to 95% chance that we're not going to make it. They lose capital and quit. You're going to lose money and you're going to get burnout and you're going to quit. It's because, and I'll talk about that in a little minute. Let's ask a few questions first. Is it because the banks are evil? Is it because the financial institutions are out there to get you? Is the market rigged? Not exactly. The 95% failure rate is because we retail traders continue to think as retail traders. Now, I want to talk about most, I would say 95 to 98% of the information that you find out on YouTube that teaches you how to trade keeps you in a retail trader's mindset. All right. The reason 95% fail is because we still continue to think like retail traders. They bring the human psychology into a mathematical arena. We need to work in a statistical arena where we employ risk management. That becomes our focus and not a get-rich-quick scheme or cash flow or how much profit am I going to make. We need to change our mindset. I beat up on that in the first or the second, third, fourth videos. And in this one, I'm just bringing it home, okay? But it's all about the money not being the focus, but about the risk management being the focus. The 95% reality is that most people who enter trading are not going to make it. Let's just be real, okay? Now, why? The first reason for failure, and I'm going to give you 3 of them. I've gone over these before in the previous video lessons. I'm just going to highlight them here again so they stick in your mind. The first one is the casino mindset. All right, the average retail trader looks at the market as a place to gamble. I'm going to take my money, I'm going to open up a trading account, and I'm going to see what I can do with it. There is no structure in that. They put in $1,000 into an account, hoping to make $10,000 by Friday. Hope is not a risk management tool. It's just gambling. Institutions look at the market as a business. Retail traders look at it as a place where they can gamble their money. Now you may say, well, I don't look at it like that. Not on the surface you may think that, but look at that big iceberg. How much structure do you have in your trading? They are looking for a 10% or 15% return per year, the institutions are, because they know how to trade. Retail traders have unrealistic expectations. We force ourselves into trades that aren't there, and we know that when that happens, it leads to an inevitable loss or losses. All right, so that's key number 1. We trade with a gambler's mindset. Number 2, like clockwork, this is the single biggest technical difference. And we need to put this in our mind. Ask a retail trader what they are thinking about when they enter a trade. And most likely they will tell you how much money they expect to make. And when you do that, there goes that focus again into the retail trader mindset. Ask an institutional trader the same question, and they'll tell you how much they're allowed to lose. Why? Because they're focused on risk management. They're focused on process. All right, institutions have risk desks. Managers who will literally shut down a trader's computer if they lose more than 1% or 2% of the portfolio. Okay? They have things in place to do that. We don't do that on our accounts. Now, did you know that out there in some of those brokers, you can actually go and set a daily loss percentage limit, and that could act as that risk desk for you. That's the reality. Those tools are available, and I'll share that with you if you come on board the NMKL Trader Academy and take one of our courses. You're going to learn that in there, okay? Retail traders often risk 10, 20, even for 50% on a single idea, on a single trade possibility. When you risk that much, you're mathematically guaranteed to go broke within a few trades. It's just going to go against you one time or another, and you're gonna blow it. All right. So risk management is the number one key that we need to focus on when we are trading. All right, reason number 3. Finally, the concept of emotional liquidity. Retail traders feel pain. You know why? Because that's your income, that's your money you're risking. And when the market drops or goes in the other direction, they panic and sell at the bottom. When the market goes up, fear of missing out, we buy at the top. Institutions know this all day long. Why? They can go out there on YouTube and see how the training's being done, and they know how to trade against us. It's that simple. So in this course, these courses that we're going to be teaching, I'm going to teach you how to identify the big moves that are happening, getting in on the big moves, and trading like a institutional trader. You got to disconnect from the emotion. All right. Institutions know this. If, in fact, algorithms that they use are designed to trigger your fear. All right. I want you to know that as a retail trader, the institutional traders will design their algorithms to trigger your fear. They push price down to trigger your stop losses. Why? Because they need all of those contracts to buy shares with. They need someone to sell 10 million shares before they can buy 10 million shares. So that's why they do it. Your panic is their liquidity. Are you starting to see where I'm coming from? Your panic is their liquidity, and the 95% fail because they are providing the fuel for the institutions to profit. This is why we need to understand how we cross that divide from a retail mindset to an institutional mindset. So how do you become a part of the 5% that succeeds? You don't need billions of dollars to do this with. You don't need a Bloomberg terminal. You don't need to be on Wall Street. You don't have to go to some big institution to learn how to trade. You must stop trading for excitement and start trading consistency. You must obsess over risk, not profit. You need to stop trying to predict the future and start reacting to what price is telling you. If you can trade with discipline that they have within the institutions, but the agility of an individual, you can survive. So let's go back to slide number 1 and just think about it. Slide number 2, where you have the big ocean again, and you got the whales and the small fish and the plankton. Stop being the plankton and the small fish. Learn to swim alongside the whales. Learn how to get on the back of a shark and follow it. That's where the current is. That's where the trend is. That's how you're going to stay alive in this game. Now, I'm going to finish by saying this. At NMKL Trader, in the next video, our academy, I'm going to share with you how coming on board with us at NMKL Trader Community will set you up with not only the trading strategy, the market trend system, which identifies big trends, and then we can follow those currents that the whales and the sharks create, or the institutional traders, and we can get in on them and profit from that. We're going to also teach you the wealth funnel on how you can trade for income, for short-term income, put away enough for taxes, put away enough for investments, and still have 35% or 30% to put on you. We're going to teach you that wealth funnel. We're going to teach you strategic investing later on in our courses. We are also going to teach you that the focus of our courses is not on the strategy. Yes, we will have a foundations course that teaches you how to trade the market trend system. But the majority of our time is going to be on the processes and the rules before you enter a trade. That's called risk management. And in that way, when we get to that pie that I'll share with you, pie chart in the next video, where 20% is strategy, 30% is account management, and 50% of being a successful trader is psychology or emotions. I'm going to teach you how to detach through risk management. I am so excited to get into the next video here in a little bit and share this concept with you, because if you're looking at trading as a future, this is the way to do it. We're going to teach you short-term income building. It's going to become an engine that's going to fuel the wealth vault that we're going to teach you how to invest in. Okay? Strategic investing and how to build an income. When engine 1 shuts down, engine 2 keeps you surviving. That's what we're going to do here at NMKL Trader Academy and our community. I hope this video has been very informational. I hope you take the things that I'm teaching to heart and you're starting to change your mindset towards trading, because it can change your future if you treat it like a business. All right, this is Nate here at NMKL Trader. I'll see you in the next video. I am so excited that you've come with me this far in this journey of these courses, these lessons. I know I've been beating up on, how to master your finances, how to, understand the trading process. And it's not about making money, that the focus should be on the process itself, risk management, account management, getting rid of the emotional factor, trading like an institutional trader versus a retail trader. I spent a lot of time on that, but I am excited to get into the content that you will start using to change your future. All right? Have a great day, everybody. See you on the other side in the next video.